Hey, welcome back to Compounding Quietly. Lump sum beats dollar cost averaging. That's what most of the data says. And yet, when most people have a large amount ready to invest, they still choose to spread it out. That gap is not ignorance. It's worth sitting with. Let's think through this together. Here's the situation that keeps coming up. Someone has capital ready. Maybe it took 2 years to save it. Maybe it came from a bonus, an inheritance, or the sale of an asset they had held for a long time. It's sitting in cash right now. They've done the research. They know what they want to buy, but they don't move. Instead, they tell themselves, I'll split this into installments and invest a portion each month. 4 parts, 6 parts, maybe 12. That feels like discipline. That feels like control. And for most people, that feeling is the entire reason for the decision, not a formal strategy and not data. This pattern is more common than most investors want to admit. It doesn't happen because periodic investing is the wrong approach. It happens because the market feels uncertain right now. It always feels uncertain right now. That is not a moment-specific condition. That is a permanent feature of investing. The question isn't, how should I invest when the market is uncertain? The real question is, what criteria should guide me when I have capital available and I'm not sure whether to move? Because the answer won't be found on a chart. It will only come from understanding your own situation clearly. This is what the rest of this video is about. The decision to invest in one move or over time should not be driven by how the market feels today. It should come from what you're trying to accomplish with this capital and from what your own psychology can actually sustain. That is the criteria. Everything else follows from it. Let's look at what lump sum actually means in practice. When you invest a fixed amount all at once, that capital begins compounding from the first day. It receives dividends from the first distribution cycle. It participates in any price movement starting immediately. Every day it sits in cash instead is a day it is not working. That sounds obvious, but when the market has been moving down for 3 weeks, or sideways for 2 months, obvious things stop feeling obvious. Here is a scenario worth picturing. You have a significant amount ready to invest in a dividend growth fund. You've been building toward this for over a year. The fund's track record looks solid, but the last few weeks have been choppy. So you decide to divide the amount into 6 equal parts and invest one portion each month. Month 1 passes. The market dips slightly and you feel good about your decision. You avoided the drop. Month 2, you invest the next portion. By month 4, the market has recovered and the fund is trading higher than when you started. You still have 2 portions sitting in cash. You're now buying those final installments at a meaningfully higher price than you would have paid if you had invested everything at the beginning. The caution cost you, but you never felt the cost. You felt the safety of the process, the comfort of acting slowly, deliberately. What you didn't feel was the opportunity cost. Opportunity cost is invisible. It doesn't appear as a red number on your statement. It shows up as a quiet gap between where you are and where you could have been. Think about what that experience actually feels like over those 6 months. By month 3, you're telling yourself the strategy is working because you haven't made a major mistake. By month 5, you're starting to wonder whether you should just invest the remaining portions all at once. You're now making a new decision on top of the original one. The process that was supposed to reduce anxiety has created a new kind of anxiety about when to stop the process itself. That's not an unusual outcome. That's what tends to happen when the method doesn't match the context. None of this means dollar cost averaging is the wrong strategy. It is exactly the right approach in one specific context, when you don't have a lump sum available. When your capital is income arriving monthly, a salary, a recurring transfer, investing it as it arrives is not a compromise. It is the right structure for that reality. You invest what you have when you have it. That is dollar cost averaging used correctly. The confusion happens when someone has the full amount available today, but chooses to act as though they don't. That is not strategy. That is delay dressed as strategy. And the distinction matters more than it sounds. Coming back to the original question, lump sum or periodic investing, the honest answer is that the question itself needs to be reframed. The more useful question is, what is the actual nature of your capital right now? If capital is arriving in regular amounts over time, invest it as it arrives. If the full amount is available now, the case for spreading it out is mostly about psychology, not about structure. And psychology is not the wrong reason. Some investors genuinely cannot handle putting everything in at once. They know themselves well enough to recognize that. If the market drops 10% the following week, they will lose confidence. They will start to doubt the whole plan. They will feel the urge to exit, and some of them will act on that urge. For those investors, periodic investing serves a real function. It isn't just a slower version of the same approach. It is a structure that gives the investor time to form a real relationship with the decision. Each installment is a small confirmation that the strategy holds. Each monthly move builds a pattern, a repeated action that reduces the chance of abandoning the plan under pressure. By the time the full amount is deployed, the investor has practiced the process enough to trust it. An investor who enters slowly but stays consistently invested will outperform one who timed the entry perfectly. Exiting at the first sign of volatility costs more than imperfect timing. So the judgment here is not which method wins in a back-tested comparison. The judgment is which method do I actually follow through on, without second-guessing, without reversing course when things get uncomfortable. That is the question that changes the real outcome. The data does favor lump sum over most time periods, and most market environments. Investing the full amount immediately has historically produced better results than spreading it over months. The logic is straightforward. Markets tend to move upward over time. Every month in cash is a month of missed participation. But data describes averages across thousands of decisions. It does not describe your specific psychology, your specific moment, or your specific risk of abandoning the strategy when the pressure builds. What matters more than the method is the consistency. If you can invest everything at once today and hold calmly through what comes next, the data supports moving now. If you know from experience that a large, immediate move would compromise your steadiness, spreading it out is not the inferior option. It is the appropriate one for who you are. The goal has never been optimization. The goal is staying in the market long enough, consistently enough, for compounding to do what compounding does. The market does not reward perfect entry. It rewards showing up consistently over time. That's the whole point. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.